This one's really important. If you want to curb your downside, you need to know relative. We spoke about equity curve, right? You want to have a visual of what you're doing so you can manage it professionally and not be an amateur, right? So that's kind of that takes. We took that to a whole new level today. You want to know your average gain, average loss, open risk, portfolio risk, et cetera, et cetera. We gave you a whole bunch of parameters. This is, some of the best portfolio managers that I know tend to use this as a tell of how they're going to manage money in the markets. So if your portfolio, let's say at the beginning of September, was up 20% on the year or 30% on the year, let's say, right? You're up 30%. Now the September correction happens, right? We get a pullback in the markets. Things are, September 2023, we get a pullback in the markets, and you're now 5% off your highs, and then you're 10% off your highs, and you're 15% off your highs. Portfolio, the way some of the most successful ones manage it is they have kind of circuit breaker approach as you give back money in terms of performance, total net performance in the markets, you have to kind of scale back your exposure, right? Let's say you're managing a large account, but the same approach can be applied to what I call like a higher low in your equity curve, right? If from May to September I made 30% on my account, right? And September I'm giving it all back. I saw one of the comments in the chat say that they gave it all back for in about a span of 10 to 15 days. That means you didn't have an approach where you're kind of stopping yourself from yourself. As your equity curve came down, you need to scale back exposure because the market's consistently telling you you're this is not good, this is not good, this is not good, this is not good, right? You're taking the elevator down when you took the staircase up. And when you take the elevator down, it's not a good feeling. In terms of portfolio management, because you're giving back from a psychological perspective, you're just back to May. And all that effort that you made, you did everything right. And then when it's time to, the market's telling you to scale back, you're not scaling back. So at 5% of your total drawdown, half your position size immediately. This is still a very broad rule, right? This is not a position-based rule. It's kind of like a total portfolio base. You can only operate at half position sizes when you're down 5% off your portfolio from your immediate high. Sell the weakest positions right away. At 10%, no new buys, raise stops up, because you need to see what the market's doing, because 10% off your immediate high on your equity curve, that's a big pullback. And literally the market's saying, if you're still buying new positions at that point and you have existing positions you should be managing, don't do that. That's a bad recipe. At 15%, you go to cash, and then these guidelines are very broad. You don't have to kind of follow these at 5, 10, 15. I think as stage 1, 2, it's better to look at, string of trades first and have these be a little bit tighter. I would say at 3%, stop yourself from yourself, at 5%, and maybe at 15 instead of 5, 10, and 15. These 5, 10, 15, it's mostly for bigger portfolios because you have such liquid positions and you're holding, I don't know, 50, 60,000 shares of Uber and, 10, 15,000 shares of NVIDIA. At that point, you need to kind of wait and see because you don't want to be, irrational in portfolio. But as stage 1 and 2, I would say, 3, 5, and 10% are really good ways to say I'm going to half my position size no matter what, because the market's giving me some negative feedback and I don't want to continue to give back that money to the market. Richard?
Yeah, nothing much to add here. I think shout out to both Eve and Mike Webster. I think they've kind of reinforced these lessons really nicely. And again, any guesses to the chart that you see over on the right-hand side? I'll give you a hint. Well, actually, I won't give that hint. I think that's too easy if I give that hint. So yeah, let us know in the chat what you think here. But yeah, this is a really important concept because we want to make sure we cap that drawdown. We don't want to just keep losing money during a correction, fight the market, keep operating the same way. We want to listen to the market, react accordingly, and protect ourselves from ourselves. So I think we can move on, but this is the cues in the most recent 2022 correction. So Rye, I guess you didn't get that one.
No, I
Yeah,
need price.
yeah, you need price. You're cheating. So earnings
Uh,
rules. So yeah, go ahead.
earnings. So always know your earnings dates. You have to know them. There are events in the market that you're giving away money. If you just go into earnings. This happened to me once in a positive way. Back when Roku was did their IPO, and about 2 months from IPO they reported earnings, and I was under I the way I understood is it takes a minimum 3 to 4 months for them to report it after the IPO. I held the stock. I literally bought it a couple of minutes before close, and I was up. Thankfully, I was up like 30% after hours, and I didn't know the earnings date. So it's good when you don't know when that happens, but the opposite could have been very bad for my account and would have been disastrous, right? It would have set me back at least 2.5 months just not knowing the earnings date. So even though that situation was positive, like the whole you need to know your earnings dates. The second one is you need to know your implied move. So if it's an IPO, it's hard to get implied move numbers, but usually the option market prices a stock at, Netflix is going to move a minimum 10 plus 10 or minus 10%. It's usually a good gauge as to what the maximum amount of move will be after hours when something is reporting. Check your profit cushion. So if you're up, let's say, for stage 1 and 2, I would recommend just sell it. There's just too much going on, and with respect to the downward trending equity curve, to throw a Hail Mary and say, hopefully this works as a lottery ticket. A lot of stage 1 traders do that. They buy options. They come up with these very creative reasons that they will be very, very rich very quickly and they will turn to stage 3 overnight. None of that happens, right? So stage 1 and 2, maybe if you're a later stage 2 trader, you can start getting into this earnings market and seeing, if I have a 20% cushion and the implied move is 10%, if this happens, then you're properly planning what your actions will be depending on what the stock is reporting. Consider selling a portion of the position. This one Ross emphasizes a lot. A lot of people, stage 3 traders, they don't act macho when it comes to earnings. They don't do that because earnings are binary events. They could be to the upside, they could be to the downside. We don't really know which way they're going to go until the news comes out and and it's time to make a decision. So always sell a portion. You could sell a third, something, so that whatever it is that happens in a binary event, if it's a positive outcome, I see a lot of, I should have held, I should have held Splunk, SPLK because it was bought out by Cisco. It's such a stupid statement to make at the end of the day because you don't know if that's going to happen, right? You can only manage risk real time, is what Richard said in the first 3 webinars, and that's what you could control at that point in time. For you to act like you know what's going to happen is far from the truth at the end of the day. So sell a portion. These are binary events. Some will work your way, some won't. And you could, gather stats as you transition from stage 2 to 3 to see how you want to manage these. These are a few good ways. First way is just knowing when they are. Second is the implied move. Third, having a good profit cushion, and the profit cushion being above the implied move is usually a good sign. And always sell a portion. That will keep you in the game, right? You see a lot of traders say, you got to find a way to stay in the game. So at stage 1 and 2, as your equity curves continue to go down, you can't stay in the game because over a span of time, you'll just blow up your accounts. So if you stay in the game, look at it over a series of trades. Even if you miss an earning gaps or 2 as stage 2 traders, it's perfectly fine. You take that as part of your journey. And at some point, when you enter that name and it goes from one earning cycle to the other and it moves ELF, like moves 40%, you have ample cushion. And then that 40 turns into 60% because it's gapping up multiple earnings cycles in a row. So steps for managing risk. I think this is more so just
it's a summary. It's kind of the key points here, the high level. So first step, place a tight and logical stop loss. You should definitely, if you've watched last webinar and this webinar, you should know exactly how to do that. As the stock progresses, raise your stop to break even. Depending on your stage, you'll know how to manage this. As the stock continues to rise, move that stop then into the money. Then you want to trail your stop based on your preferred methodology, whether it's below significant higher lows with a moving average, whatever your process is. Then you want to consider selling into strength as the stock gets extended from your buy point. This can be based on a percentage gain, a percentage from a moving average, ATR multiple from a moving average, risk multiple that you're at, whatever makes sense to you and your process, go for that. And then the last step is, sell the rest of your core position into weakness as your backstop gets hit, as the stock changes character, changes trend, breaks below the moving averages. That's kind of the overall method for both managing risk as well as managing the overall position. So hopefully we've kind of brought everything together into these 6 key points. If you can do this with every trade, you're golden. And if you don't yet have rules that kind of address each of these 6 points, you need to implement them.